Anthony, thanks so much for joining us, and congratulations on your first quarter as a public company.
Thank you, Diana. Good to see you.
I want to get right to it. You recorded record origination volumes of $41.5 billion. That's up 11% from the previous quarter, but net earnings down 22%. What happened there?
Well, what we're seeing today, Diana, is the fact that record low interest rate that was fueled by the pandemic. And we're seeing rising interest rates. And as a result of it, origination is forecasted to come down. So you have overcapacity in our industry that has to catch up to the new demand, which is lower than last year. So you have a lot more competitive pressure, but it's going to be a temporary matter. Overall, there's still $11 trillion market share. And certain companies like LoanDepot are well positioned for the future.
Well, as you said, we are seeing refinance volume down, applications down over 20% year over year because of those rising interest rates. The market is getting more competitive. How do you stand out? And is this great for the consumer because they might see lower rates due to that competition in the market?
Competition is always good for customers, obviously. But what we need to understand and remember is that rates are still at historical lows. Certainly, they were lower 3, 4, 5 months ago, but still very attractive in today or historical standards. And it is good to have increased competition for customers to shop. Now, keep in mind that as we move forward and the competitive atmosphere starts to increase, I think it's just important for consumers to call out the value, and that is the service levels, the brand, the image, and the overall speed of the value proposition as they look for a home to buy or refinancing.
Now, we're also seeing applications to buy a home fall lower, a lot of that due to the constraints in the market. There's just very little for sale. Do you expect to see that purchase volume to fall even further as people just can't find an affordable home to buy?
Well, this year's a little different, Diana, right? We're getting into the spring buying season. Certainly, volumes usually spike for purchases during Q2 and Q3 as it goes into the fall. But inventory is lacking, and some of our home builder partners are building as many homes as they possibly can with rising costs to produce. That has not slowed things down as the demand for housing is at an all-time high, it seems like. But I do see the seasonality picking up, and I do see the summer to be a lot better than it is today.
Anthony, it's Kelly here in studio. You've long been an innovator, kind of at the forefront of this industry, the past decade or so in a lot of different ways, the technology that you use and so forth. So where are you on the blockchain? I mean, is this an area where you are engaged and actively trying to think about how it's ultimately going to transform, the home buying process, or does it have nothing to do with your day-to-day and is not something we should expect to hear about in the home buying industry for still quite some time?
It is an absolute area of great interest for us, Kelly, and we continue to monitor it very closely. The mortgage process, to many, is a broken process. It takes so long to close a loan. It still takes 45 days or so to evaluate someone's application that the industry has already evaluated. And to have an appraisal on a property, the average home in the country is 30 to 40 years old. That home has been appraised dozens of times before. The data collection and the digitalization and the advancement of our industry is happening as we speak. And this is why some of the companies such as ourselves, by investing into our own proprietary technology, really gives us an edge as we move forward as innovation continues to change our industry.
Anthony, we talk a lot about mortgage credit availability. You sell 100% of your loans to Fannie, Freddie, Ginnie Mae through FHA, so you don't hold any portfolio loans. We're seeing some tightening in the second mortgage market, that is investor mortgages and vacation home mortgages. There's a huge demand for vacation homes now. Is it getting much harder now for your customers and for you to originate second home mortgages because Fannie and Freddie have now put a limit on the number of those mortgages that they'll buy?
So the vast majority of our loans are agency or FHA and VA. It is not 100% because we do go into non-conforming and jumbo products. But Diane, to your point, anytime you have a trend change, and that's where we are right now, you have higher interest rate, and what you're looking at is affordability because of higher interest rates, along with appreciation of home prices. Risk evaluation starts to come into play. And that is, everyone wants to forecast defaults before defaults happens, because as a lender, you don't want to get caught too far behind the trend change. So second homes is viewed as additional risk, higher risk than primary home. If we do get into some sort of a recession where defaults go up, certainly the last home that you're going to default on is the one that you and your kids live in. So second homes are slightly higher risk. So I think given some of the learnings from the previous cycles and certainly the financial crisis, I think it's just the proper diligence that many credit review and credit underwriters are looking at, because we've been in boom times for so long, and everyone is just scared of the falling knife a little bit, looking ahead and trying to properly risk assess if this economy starts to change.
Shepard Smith here. Thanks for watching CNBC on YouTube.